1 year to 3 years, although we can go as long as 5. Our typical interest rates are 12% would be normal, a couple of points. So there's a basic idea of what the fund does. A completely separate company within our office is Winter & Company, which actually this month is 20 years old. I started that as a commercial mortgage brokerage firm. There are now 6 other people that focus on that business while I focus on the fund with my colleague David Hayden, who's my co-manager. Winter & Company is handling conventional multifamily properties, retail properties. Just 2 quick examples. Today we quoted a $12 million deal through an agency like the type of business that Evan does at 5.22 with half a point bank fee for a 10-year fixed rate loan. So that's how amazing the agency deals can be these days. Yesterday we closed a Brooklyn Heights office building, about 150,000 square foot office building, and that was a 6.75% 10-year fixed rate with very light prepayment penalties. So it's a whole gamut of real estate financing. When somebody walks into our office, depending upon their needs, we can either handle a deal with our internal fund, which is managed by David and myself, and we are the loan committee able to make a final decision on whether a deal is going to close or not, or we can handle it with banks if we have the time and the property has the cash flow.
Great, thanks. I'd really like to start the questions off with a discussion about multifamily investing and the loans that are, required to support investing into that. I personally invest into multifamily investing, and a large part of our membership does as well. I think it's the bread and butter of at least Manhattan, Brooklyn, and really the 5 boroughs of Manhattan. So I know not all of you can speak to this, but I would like, in turn, each of you to, if you have something to say, really tell me what's going on in multifamily investment. I hear there's a credit crunch. Greg just told me about some great deals, or that I can tell about based on the rates. So what's the problem? What if I'm looking at, say, a $5 million building today that I want to get into? What am I up against? What do I need to do? And what are the issues I should be aware of? Let's start down at the end with Lowell.
Well, there is money available, but the money availability comes from a few different sources. One is the private lending or the funds, and that is at one price level. The government-sponsored funds, which is at a much lower price level, and then there's your regular portfolio lenders like ourselves at bank rates. So there's a big difference in the cost. The cost factor for the client is sometimes driven by the fact that they must close very quickly. Some banks are not capable of closing quickly. We are capable of closing quickly. Regulators are on our backs every day about the leverage. So we cannot do the leverage that the private funds will do. So we're looking at 75% leverage, we're looking at 70%, and a lot of that is driven by where those rents are relative to the market. The lower the average rent within the building that you're buying, the better deal I can do leverage-wise. As the rents start to creep up near the market, the worse the leverage is, because there's no upside. So we like to look at deals that have tremendous upside in the rents, and then we can come in with very, very competitive rates and structure in order to give people either a short-term loan of 18 months or 24 months, or as long as a 15-year self-liquidating loan. We do require 1.2 debt service coverage. If we don't get a 1.2 debt service coverage, we then look for personal recourse. And the personal recourse has to be able to show that they can support the loan. There are many times we get a deal and the fellow says, I'm willing to sign, and I look at his tax return and he lives in Great Neck and he has 4 children. His home taxes are $26,000 a year, yet he only reports $15,000 a year on his tax return. So the problem is I can't sit down when my regulator comes in and examines the books and says, Mr. Dansker, why'd you make this loan to this guy? I say, well, I know he's good for, he's in the laundry machine business, or he's in the diamond business, or he owns parking lots. They accept that up to a certain point, then they downgrade their loan, and we've got to put up more reserves. The process has gotten a little bit more difficult because of the government requirements, but I do think that of the New York area banks, my size bank, the size loans we do, I think that we do the best job of underwriting and doing it quickly and getting the deal closed. Earlier today, I closed an office building loan on a 200,000 square foot office building down on Varick Street. It was an $11 million deal, very low loan to value. The pricing was, I think, 6% fixed for 5 years on a 30-year schedule with some small fee up front. My client was thrilled. It took us quite a bit of time today to get it closed. He was paying off a conduit loan. One of the things I mentioned to Ryan when I came in today, that we are getting offered deals that are payoffs of conduit loans. They are very difficult to pay off. There's a window of opportunity that's about this big when you have conduits that have been holding reserves or other collateral accounts. They don't want to release them. My borrowers are trying to get the money released. It's extraordinarily difficult. We work with them. We don't penalize them for it, and we put in a lot of time and effort to get it closed for them, either through the title company, which has to hold the money for a few minutes, or through some other agent. So the process is a little more difficult than it was during the boom times, but it's still doable. We portfolio those loans, and we service our own loans.
So, John, does Kennedy do multifamily investing, multifamily buildings? What's the sort of the minimum size, and what sort of deals do you do, if at all? Sorry, John Horner.
We prefer not to do a deal less than $1 million. It's the same time and effort. Multifamily is easy for us to do. We again look at it as a bridge loan, an interim loan that we put into place. We're strictly based on value. We're trying to figure out that if for some reason this loan doesn't work out, what can we sell the asset for, and we'll go up to 60, 65, 70% of that asset value. And that's how we do our underwriting. That's where our credit lines allow us to pull down from, and they're up and flowing now. And that's where what we call our co-lenders participate with. So again, the product doesn't matter to me. It's coming up with the proper value and then agreeing on the loan amount to make sure it could work. Our pricing is 12% interest for your first year and a few points on top of that, depending and varying on the asset. But in a couple of years ago when we were competing for loans, that pricing turned a lot of people away. Today, there's much less competition in the market, and if you're out there lending and closing loans on any type of asset, then you really could be aggressive. We too can close quickly. We are set up to close most loans within 10 days or less. The quickest loan I've ever did was in Vegas. We did it in 48 hours. We ended up switching to Nevada law because we knew the friendly foreclosure provisions there, and it worked for us. So that's the quickest I ever did, but I will tell you, a bank backed out of the deal, and the loan package came in and it was pristine. It was like wrapped in a present. Title was perfect, and we went through everything. That rarely happens, but we're geared up to close quickly, which isn't as important today as closing as it was 2 or 3 years ago when the market was hot and people were competing.
So what's the longest term you'll do? Is it 18 months, 24 months?
We'll do it. We'll write our paper. The most we could do on our lines right now is 3 years.
3 years?
Yeah.
And so what circumstances would someone use a loan from you? Obviously not to buy and hold. It would have to be a value change situation, renovation, or they're looking to move it from just get from where they are now to sale?
They're a perfect example on a multifamily right now. Their debt is coming due. They can't afford to pay it. Their lender wants to be out of that asset's market right now. We're getting a lot of calls from people that say, please call our lenders. Our asset is not worth what it was when we financed, we're impaired. Speak with them, see what they could do. And they're going to take cents on the dollar, and we'll provide the financing for that. We'll even buy the note and transfer it over and allow them to sit for 2 or 3 years. What's going on out there isn't going to last forever. And it could be a great opportunity. We view this market as an opportunity for people to buy real estate, get their hands on notes at a discount, and we're happy to finance it.
So it could be as simple as buying time, not
Yes.
necessarily taking for an exit. Okay. So Bob, I'd like to hear from you about multifamily investing. You see a lot of deals go by, and obviously the financing can be, you can have a willing buyer, a willing seller, everything's fine, but it doesn't go through, is my understanding.